The easiest way to earn compound interest is to stop paying it. My name is Darius.
And I'm Carmen. Woo-hoo-hoo. I'm excited to actually go through this because Darius taught me a lot with this topic as far as just understanding how compound interest works and how it can work against us. Because I don't think that we all really understand how compound interest can work against us because we're just so used to paying interest we don't think about it.
Right.
So I'm excited for all the amazing information that you're going to share with us.
Right. And when it comes to our debt and income, we have to start thinking about what we spend our money on. So when it comes to loans, we have personal loans, we have student loans, we have mortgages, we have credit cards.
Yeah,
that's where the bulk of our money goes. To a sum of about 14% of our after-tax income goes to these interest payments.
You said 14%?
14% of our income goes to interest.
So if we had $100,000 salary, $14,000 annually would just go to interest.
If we had $100,000 net,
yes.
14% of it would go towards interest.
So we're basically buying a used car every year.
No,
just in interest.
Yeah, we're basically donating a used car.
Donating. Okay, I got you. That's where you're coming from with that.
Now, when it comes to us, instead of paying it, we have to figure out how we can earn it. Yeah. And the reason why we pay it is because we don't understand how this compound interest work or where we even paying compound interest. And those things that I just mentioned to you, you pay compound interest. And more specifically on your mortgage and credit cards, you pay sometimes interest on a daily basis. So what that means is the longer that balance is outstanding, the more interest you will pay over time.
And I think we all understand this to a certain extent, especially when you buy a home, because you're given your amortization schedule and you kind of look at it and you're like, oh, that sucks. But then you don't process it. Like you, when we bought our house, we knew we were going to overpay significantly because of the interest, but we didn't do anything about it.
Yeah.
Right. We saw the amortization schedule. Can many of you relate? Let us know. Comment below. You saw the amortization schedule and was like, all right, this is what it is.
So the problem is by the time we see it, by the time we go to buy a new house, it's already too late.
Yeah,
because what we have to do is prepare for it ahead of time. So when it comes to our house, let's say the average mortgage is about 4.44%. That's the average interest rate on a mortgage, and that's compounded daily. So that's why over 30 years we see that we spend almost double the house in 30-year time frame on a small interest rate because it's compounding on a daily basis. Now, even with the credit card, 43.3% of consumers carry a revolving balance.
That's almost half.
43.3% of us carry a revolving balance, and the average interest rate on a credit card is 16.3%.
That's the average?
16.3%. So if we take the mortgage and just the credit card, and not only do we pay the credit card off on a monthly basis, but we save up for a house or pay our house off earlier, we, instead of us paying that interest, money still has to go somewhere. We should then take that money and redirect it back to ourselves because that minimum payment includes a daily compounding interest rate.
Now, I think we need to clarify the daily compounded interest rate because there's going to be many people like myself. When we were talking about this, I was like, are you sure about that? Like, let's go ahead and get our fact checked, make sure that it's right before we put it on YouTube and people tell us that we're wrong. But I think we have a real reputable source, right?
Yeah. So let's take a look at Rocket Mortgage. We're just going to take a little snippet out of an article that we read in Rocket.
That we read.
On rocketmortgage.com. And it says that, so when compound interest can be harmful. When it's an investment, compound interest acts as the wind at your back. When we talk about debt, compound interest works in the other direction. Loans, student loans, personal loans, and mortgages all tend to calculate interest based on a compounding formula. Mortgages often compound interest daily. With that in mind, the longer you have a loan, the more interest you are going to pay. So with us understanding that, we can't unlearn it, right?
No.
So now what are we going to do about it? What are we going to do about it with this, now that we have this information? Will you rethink or prioritize how much you're spending on your mortgage and your credit cards? Will you rethink actually having paying your debt off every month versus having a revolving debt? what decisions and what changes are you going to make? Well, I know for Carmen and I, we were in a similar situation where we had over 6 figures in debt between personal loans and credit cards, 6 figures. And what we decided to do is we got our finances organized to where we were seeing exactly where we were spending money frivolously.
Yeah.
And we made adjustments based on our spending. And what we did first is we cut out the frivolous spending, i.e. eating out at restaurants every day and sometimes twice a day. And we redirected those funds and started putting them into our savings account. Because what's important is we were overspending because we were paying for stuff that we shouldn't have got in the first place.
Yeah, we shouldn't have bought. So what I would say to accentuate this point that you're making as well, the reason why we started organizing our finances and focusing on savings is because the average American spends more money in interest on a monthly basis than they save themselves.
Right.
So when we understood this note, we were like, wait a second, we got to beef up this savings, because what we know with the amount of debt that we were in, we were spending way too much in interest. So we started looking at things and said, okay, we need to prioritize ourselves instead of prioritizing all of the financial institutions and everyone else, because we're the ones earning our income. And we need to make sure that we set ourselves up for success at the end of the day.
Absolutely. And then the next thing we did is we actually got whole life insurance policies. We redirect our savings account after we've built up enough money for our emergency. We start directing our savings to a whole life insurance premium.
And to again, further accentuate that, when we realized that we just kept our money in a savings account, it wasn't keeping up with inflation. And we had to figure something else out, right? So that we baby stepped this thing. We started saving money, and then we saw the money building in our savings account, and we said, okay, what are we going to do with this? We need something better than just a savings account. And that's when we stumbled across whole life insurance and realized that if we get a overfunded whole life insurance policy, meaning maximum cash value, we can have a savings mechanism that's building in a life insurance policy, and we have life insurance at the same time. So it's a double whammy, because if you keep your money in a savings account, you don't have any death benefit or anything that you can protect your family with. But if you just change the vehicle that you're putting money in, instead of a savings account at the bank, you put it in a whole life insurance policy with maximum cash value. Now you have both. You have your savings and you have your death benefit to make sure that your family is protected.
Right. And then what we did is we took the cash value from our whole life insurance policy, and we paid off our debt, and we continued making the minimum payments back to ourselves. Now, the important thing to understand is that when we borrowed money from our whole life insurance policy to pay off our debt, we were still continuing to earn the same amount of interest as if the money was still there, because it was.
Yeah. And the important thing to note too with this is not only for us was it important to make sure that we had our money in a vehicle that was prioritizing us, in the sense of it's earning a guaranteed rate of return, which happens in whole life insurance policies. In addition to that, we have control, and we have the ability to leverage those funds to do whatever it is that we choose. And the money still continues to earn, regardless if our money is outstanding or not.
Right.
So the point of this video is we were talking about how to earn compound interest, right? So what Darius just proved, according to Rocket Mortgage, is your mortgage, the credit cards, any loans that you have, things like that, they're compounding on a daily rate.
Well, our mortgages and our credit cards are compounded on a daily rate. Our personal loans and student loans, they compound, but not on a daily rate.
Exactly. So when you think about all of these loans that we all probably have or have had at some point, we're paying compound interest. And that's how this is working against you. And once you realize that all of these liabilities or assets, whichever one you think that they are, whichever one that you possess, you have to then realize, okay, how can I change my trajectory to make sure that these funds are now coming back to me? So when we realized that, we said, okay, how can we take ownership of the debt that we currently have, start paying it down, and then the funds that we were already paying, like Darius said, whatever the minimum payments are, we're putting that money back into our savings, because we're paying that money back to ourselves as opposed to spending frivolously.
Right. And just maintaining the minimum payments on, like, for example, your mortgage and your credit card, is the compound interest is already built into it. So the only thing you have to do is just continue making the minimum payment, just redirect it back to yourself. Now, that solves our problem for getting out of debt. Now, when it comes to us financing other things that we need, which is how we got into debt in the first place, because of our need for financing, we just use our whole life insurance policy, again, because we have the funds available. And then when we borrow those funds and buy the item that we want, or the item that we need, we pay ourselves the same way we would pay ourselves back the same way we would if it was to a bank. And the reason why is because we want to continue to use those funds over and over again.
Now, and let me interrupt you real quick. If you are interested in doing exactly what we're talking about and using whole life insurance, not only for a savings mechanism, but also for your source of financing, then definitely click on the link below. We'd love to serve you at the Wealth Nation.
Right, because it's so important for us to really understand this, because year after year, what we're doing when we have these other loans, we're making somebody else very, very wealthy. And instead of you making somebody else wealthy, what is that doing for you? Yes, you have your brand new house that you can say that you have as a result. Yes, you have whatever you bought with your credit card as a result. Yes, you have the education because you used your student loans to pay for it. But what if you could have more? What if you can have those items and the cash at the same time?
And I think the visual to paint too, you alluded to this earlier. If we think about our salary, if we make $100,000 every single year,
minus 14,000 that goes.
wait, no, I was going to use that as my example. So let's say we make $100,000 every single year. Starting January, in December, what's in your bank account? What do you have to show for? Sometimes we have half, 10, 15, 20%, maybe nothing. I want you to just stop and think about that. When you go the whole year of whatever salary that you have, what do you have to show for yourself at the end of that year? And what we just want to empower you all with is understanding how to keep more of your income. Because when we think about compounded interest, sometimes we're going to the stock market or we're going to all these other vehicles that will help our money earn. But the main thing is we want you to understand first is keep more of your income so that you can then create more opportunities for cash flow. So if you are protecting more and more of your income every single year, what is that going to do for you and your family? So for that example, the 14% that we're spending in interest, what if we were able to redirect 7%, half of that, 14%? What if you could turn it all back and now you're sitting on another $14,000 annually that you were giving to the financial institutions?
Just in interest.
Yeah. What could that do for your family? Just a thought.
So let's go back to this 20% thing, because we're only taking in consideration mortgages and credit cards.
You're talking about 20% compounded interest.
20% compound interest. And the reason why we pointed that out, because it compounds on a daily basis. Now, when we go and we look for investments, what investments that we know of can give us 20% return?
Drug dealing?
That's
not an investment.
That's not an investment.
I don't know.
What you have in your coffee?
Well, I'm thinking of we've never received 20% more plus on real estate and some of the things that we've done, and even lending.
But we have, because we had all the money. We didn't have to split it with anybody.
Okay, I see what you're saying.
So the moral of the story, the point that we're trying to make is when you have control of your money, you're able to make more money. And for example, if a lot of us, we have about 5% or 6% of our income going to a retirement income, like a 401k or government, some type of retirement income. The other 95%, what we do with it is we pay bills and we pay interest, and we don't put anything aside for ourselves. What we're trying to say is pay yourself first, take a small percentage of your income and put it towards savings. That's savings. The next thing you need to do is figure out how to redirect the interest that you're spending. How do you make that interest come back to you? Because if you don't understand compound interest, for those of us who don't understand compound interest, pay it. And for those of us that do, earn it.
One more time.
For those of us that don't understand compound interest, we pay it. And the ones that do, earn it. So which position do you want to be in? Because there's no in the middle.
No, but there's no middleman concept when this comes in fact. So to bring this,
actually, when it comes to money in general, there's really no middleman. There's either people making money or people losing money. Yeah, that's it. So what position do you want to be in? You can choose, and the more simple you make it, finding the compound interest the interest that you're already spending on a monthly basis out of your income, that's the easiest way to make money, because it's something that you're already doing, and you can create a new habit to redirect it someplace else.
Yeah. And that's what I just wanted to reiterate, to make sure that we're all tracking at the same time, right? So what we are talking about is the ability to earn compound interest. And you don't have to look outside of what you're already doing in order to earn compound interest.
Because you're already paying it.
Because you're already paying it. So if you have a mortgage, congratulations, you qualify. If you have credit cards, congratulations, you qualify. And
if you got personal loan, congratulations.
Yeah, exactly.
If you got student loan debt, congratulations.
Sign me up. So all you have to do is realize, okay, how much money am I currently paying on an annual basis just in interest to these financial institutions for these things that I have? Now we have to figure out a win current that we can create for ourselves via our savings account, where we can then put that money into a whole life insurance policy that will earn a guaranteed rate of return, keep up with inflation for us, and protect our family in case anything happens to us. And that we can also leverage to start throwing at our debt to pay off these debts. And now the income that we are contributing every single month towards these debts, we can save it for ourselves and now retain that compound interest that is going out every single month. So I want to make sure that we simplify that so you understand the concepts that we're talking about. Because again, don't get so caught up in what mechanism do I have to start doing to start making as much money as I possibly can. We're going to say start saving more of your income.
Right.
And how are you going to do that? By starting to own your own debt.
Right. And the reason why we're saying a whole life insurance policy versus a savings account is because, yes, both you do earn compound interest. In your savings account, when you let the money sit there, you earn interest. And then the longer you let it sit there, you earn interest on top of the interest that you earn.
Which is compound interest.
But the thing that happens is as soon as you use that money, you're no longer earning interest because the money is no longer there. You'll be earning interest on a smaller amount.
So let's do a visual. And we'll just use our hands for this because I'm a visual person. For all my visual homies out there, hopefully this helps. So in your savings account, right, you're stockpiling money, you're saving, and all of this money is earning interest, interest on top of interest. Now what happens? An emergency comes up. Now you have to deplete some funds. And now you're earning interest on a smaller amount, on the amount that is there currently. You have another emergency that comes up and you don't pay it back. Now you're earning interest on a smaller amount.
Ooh.
So that's how this thing works.
Yep, absolutely. Now, when it comes to
done with my hand signs?
Done with your hand signs, but I'm come back to it. Now, when it comes to a life insurance policy, whenever you pay your premium, you have a cash value that accumulates inside of your policy. And what you do is you leverage this life insurance policy to borrow money. Now, when you borrow this money, you still continue to earn interest because it's still growing. Now, you take the money that you, the cash value, and you use it to make more money. So now you're earning interest in your life insurance policy and interest outside of the life insurance policy.
And to go back to that point, because I don't know if it's as easy to understand. When Darius said you're going to get a loan to make more money, we only recommend that you get a loan from your life insurance policy, or AKA use the savings in your policy, and unless you're going to turn a profit.
Right.
We're not saying to just take the funds and not pay them back and spend them frivolously. No, we need to be strategic with this.
That's how you become broke.
Yeah, well, that's how you get into trouble with anything in the first place.
Because what we're talking about are three different scenarios in which you borrow money. You borrow money from the credit card company, the bank. And when you borrow money from them, you have to pay them back on a monthly basis, principal and interest, right? That's what we do. That's the 14% of our income is going back to a third party lender.
Yeah.
When we have a savings account and we use funds, we have to put that money back. Because if we don't put the money back, then it won't be there when we need it the next time. Yep. So we're still financing. We're financing even if we use cash in our savings account, and we're financing when we use a third-party lender.
And the reason being is because you're always making payments. You're either making payments to your savings account every month to build it, or you're making payments to the lender every month.
Now, what we're saying do is have the best of both worlds, where you use your life insurance policy as a savings account, and when you borrow the money, you still have to put the money back the same way you do your savings account.
You should be.
What we're saying is use it for your lending needs, your financing needs. So instead of getting a credit card at 16.3% interest and having revolving debt, why don't you do that to yourself and pay yourself back to 16.3% interest? Now you have the principal and interest, so you can reuse at another time plus the interest.
Now, I don't think that we finished the point as far as how the cash grows inside of whole life insurance policy. So every single time that you're paying inside your whole life insurance policy, the money is earning interest. And even if you borrow, let's say you borrow, the money is still earning. So even though I borrowed, my balance isn't going down. It's going to continue to earn because I'm leveraging the death benefit inside the life insurance policy as my collateral, and the insurance company allows us to use their money instead of ours so that our balance isn't affected, which gives you super duper amounts of leverage, because now your money is continuing to earn that guaranteed rate of return.
Right. And just the simple way, the simple thing of changing where you get your money from and paying the interest back will change things for you drastically. And when it comes to just the 20%, we earn way more than 20% interest because of how often we use our system. The more we use our system, the more money we make. The more you use somebody else's system, the more money you spend, and somebody else make the money.
Yeah. And I think one thing to note that we haven't addressed is that when you do borrow money from your life insurance policy, there is a fee, that there is a loan fee that's associated with it. And typically, though, the life insurance companies that we work with, it's 5%, but it's simple interest. So we don't want to make it seem like this is all peachy keen. There is going to be a fee to that. But if you realize that you're already paying 16% to credit cards, if you're already paying the 4% to your mortgage or whatever it is, you're already paying that amount of money, and it's not the compounded rate. We're just talking about simple interest.
Yeah, annual simple interest rate.
Yeah, so you already have that fee covered. As long as you continue to pay yourself and pay yourself with the interest that you're paying the banks, that 5% is going to be well covered within just a few payments.
Yeah, absolutely.
And you're still able to control all of those monies and see how everything works. So we want to make sure that you understand how this works, because we also did a video where we showed you how we paid all of our debt off using a life insurance policy, and you can click on that link right here if you want to check out that video after this one.
So a good example of this would be the average interest that people pay on a credit card is about a little over $6,000, close to $7,000. So let's say we borrow $10,000 from a whole life insurance policy, and the most we will pay is 5% simple interest on an annual basis. So 5% simple interest on, did I say $10,000?
Yes.
$10,000 is $500.
Yeah.
The interest itself on a $10,000 credit card is way more than $500 on an annual basis, and the reason being is because it compounds more frequently than it does when we finance our credit cards.
Yeah, and depending on what balance you're keeping, that's 2 months worth of interest sometimes.
Yeah, even if we pay the same amount of interest, because of the frequency in which it compounds, we'll still have more money just by financing it through a life insurance policy that only charges you simple interest on an annual basis.
No, I'm totally with you. So I think the moral to the story with this video is, first and foremost, getting a hold of your finances and understanding how much you're paying in interest, and realizing, again, like we said, one more time, if it's a mortgage, if it's credit cards, if it's personal loans or student loans, which the majority of Americans have all of them, you're probably paying a ton of money in interest, which is compounded. So if you are doing that, now it's time to shake, to take a little shake, wake yourself up, and realize all the money that is leaving your household every single month, every single year, and start doing something about it. Like Darius said, you can't unlearn this information that we just shared with you. So what are you going to do about it? Are you going to continue to pay all of your hard-earned income out to somebody else? If you do, let us know. We'd love to keep it for you. We can do something else with it.
Yeah, if you already like giving away money, might as well give it to us.
We'll do something great with it. But in all seriousness, just understand what's happening, because we joked on a video last time. We were saying, who do you know that doesn't have money borrowed out in one of these entities? And we couldn't name not one person. Yeah, we know a lot of people that have borrowed money. Yeah, but student loans, mortgages, credit cards, like we couldn't name one person. So this is important because it affects everyone. And if it affects as many people as we think it is, it's important for you to start screaming from the rooftops and start informing your family and friends and letting them know how much of a fortune is being eroded every single year in just interest payments.
Yep. Yeah, debt is something that you're not going to avoid. So what you can avoid is who you're in debt to. So the contracts that you create with third-party people, you're indebted to those people. Now, when you use your own system and your own life insurance policy, you're indebted to yourself.
Yep. And what I love this quote, we got to trademark it. One man's debt is another man's
Cash flow.
Darius Britt, ladies and gentlemen, who came up with that quote himself.
And more of the story is you need to look in your backyard first before you go out trying to find other investments that you can do, because a lot of times the money that you're spending on a monthly basis, you can save a lot of that income and redirect the money that you already currently have in your possession. You can just do something better with it, like invest.
You know what? You said look at your own backyard, and it made me think of COVID, like the whole pandemic. I feel like this analogy, bear with me, guys. I feel like the whole COVID analogy made everybody look at their own backyard literally and be like, oh, you know what? This house isn't too bad. Let's hang out in the backyard. Let's do this. Let's make some improvements. Let's do this. So that's what we want you to do with your own household. Start cleaning up. Start analyzing what it is that you have in your possession, that it's a beautiful gem that you have, and how can you continue to just make it better and make it more yours. All right, Wealth Nation, if you want to continue to learn how to create your own banking system, then check out our next video so you can keep learning and keep growing with us. Go ahead.
Remember to own your own lifestyle.
Or someone else will.